Beijing sends the silver market into a frenzy. 660 tons flooded in after an unprecedented lockdown. The silver market did not simply turn around, he was strained. In October 2025, without warning, without a spectacular conference, without a clear public justification, China injected over 660 tons of silver metal on international markets, a volume so massive that it instantly shattered forecasting models, disoriented traders, and shook a deeply ingrained certainty: the idea that the silver market was structurally under Western control. This move was not just a historical record, it was an act of rupture. Just a few weeks earlier, the same Chinese government had tightened the screws on the supply chain. Licenses were restricted, exports slowed, and inventories were frozen. The result? A severe supply squeeze, soaring prices, panicked manufacturers, and investors convinced that a prolonged shortage was taking hold. Everything seemed to indicate that silver was about to enter a new, sustained bull market. Then, abruptly, Beijing reversed course. What makes this decision so disturbing is not its scale, it's its timing. As global demand exploded, driven by solar power, electrification, the energy transition, and tax arbitrage, China chose the precise moment when the market was most psychologically vulnerable. Prices were high, speculative positions saturated, and supply chains under strain. And that's when the 660 tons arrived, like a cold wave on a blazing fire. Imagine the scene for a moment. The world's leading player in the silver industry, the one that controls production, refining, and a massive share of industrial consumption, suddenly decides to drain its internal stocks to supply Western markets, not gradually, not cautiously, but in a single, powerful movement impossible to ignore. The London Metal Exchange then became the scene of an event few had anticipated: a sudden abundance in a market built on scarcity. Officially, the objective was simple: to alleviate the shortage, calm volatility, and stabilize prices. Unofficially, the message was much deeper. Beijing had just reminded the world that money is not just a commodity, but a lever. Because this maneuver only makes sense when you look at the whole sequence. First, create scarcity in the global supply by keeping the metal within the country, allowing prices to rise and tensions to build. Second, abruptly release a colossal quantity to break the speculative momentum and regain control of the market narrative. Finally, and this is where everything changes, prepare the ground for future tightening, under the guise of industrial security and economic sovereignty. In doing so, China shattered its traditional image as a silent accumulator of precious metals. For a moment, it transformed itself into providential supplier. But this role is not a surrender of power, it is a demonstration, a way of showing that the tap exists, that it can be turned on, and above all, that it can be turned off again when it serves broader interests. At that precise moment, the market did not only react to volumes, it began to understand that something essential had just escaped it. What many interpreted as an impromptu decision is actually the result of a precise entanglement of economic, industrial, and political forces. Nothing here is accidental. Every variable was already in motion long before the 660 tons reached London. First key factor: Chinese industrial demand. By the end of 2025, it doesn't just progress, it accelerates. Silver is no longer a secondary investment metal, it has become a critical component. Third stage: regaining control. December 2025. New announcement. Starting in January 2026, exports will once again be regulated. Mandatory licenses, increased monitoring, priority given to domestic supply. Silver is officially reclassified as a sensitive resource. The market then understands that the period of abundance was merely a temporary respite. This pattern reveals a dependency that many preferred to ignore. Between 1/3 and 3/4 of the world's new money flows directly or indirectly through China: extraction, refining, processing. Under these conditions, talking about market prices becomes almost theoretical. Every opening or closing of the Chinese tap acts like a global switch. The peak of 660 tons is therefore not an excess, it's a demonstration of capability. And this type of demonstration is never carried out without intention. The lesson is brutal because it destroys a comfortable illusion. The price of money is not the pure result of a neutral equilibrium between rational buyers and sellers. This idea is seductive, taught, repeated, but it is incomplete. What Beijing has just demonstrated, without ideological rhetoric or moral justification, is that the market obeys first and foremost those who control the pressure points, not to those who recite the models. By locking down supply, then flooding the market, then announcing another lockdown, China did not just act on prices, it has explained the actual mechanics. It demonstrated that a sufficiently powerful state can transform a metal into a geopolitical variable, just like a currency, an interest rate, or a trade sanction. From that moment on, money ceases to be a simple financial asset. It becomes an instrument of sovereignty. This shift is fundamental because it forces us to abandon a naive view, that of markets as autonomous, self-regulating spaces independent of power dynamics. In reality, some markets, and money is now clearly one of them, are gray areas where finance meets strategy, where logistics becomes political, where raw material becomes message. When Beijing opens the tap, it's not to help the market. When she closes it, it's not to protect prices. It's to impose a rhythm, to reiterate a hierarchy, to test reactions. And that's where the mental shock takes place. Because if money can be manipulated in this way, then the question is no longer, will it go up or down? The real question becomes, who benefits from it going up, who benefits from it going down, and when? From this point on, the entire understanding of wealth changes. Precious metals are no longer simply safe havens against inflation or instability. They become silent pressure tools, means for a state to support its own industry, weaken that of others, and influence capital flows without ever uttering a word. This is an uncomfortable truth for the individual investor, because it dispels the notion of neutrality. It reminds us that the freedom of markets is often conditional, temporary, and reversible. And above all, it shows that global economic policy is not expressed solely in speeches, key interest rates, or official agreements, but also in stock movements, export licenses, and seemingly technical administrative decisions. Assets like money don't rise just because the real economy is recovering. They rise when a power decides that the time is right. This statement is unsettling because it shifts the responsibility. It forces us to understand that investors who ignore geopolitics are playing a game whose rules they don't fully understand. It necessitates a complete reevaluation of what it means to analyze a market. At that precise moment, an invisible border is crossed among those who look at the graphs and those who observe the decision centers. From now on, remaining passive is no longer a neutral position. It's a choice. And in a world where major powers move markets like chess pieces, inaction becomes a risk in itself. The first mistake that most investors make is confusing diversification and dispersion. Diversifying doesn't mean randomly multiplying assets. It means moving beyond a narrow range. Focusing exclusively on stocks, a single geographic region, or a single monetary system is like betting that the world will remain stable. But everything the recent Chinese monetary sequence has shown is precisely the opposite. In times of political and economic instability, tangible assets are not a luxury. They become a counterweight. Precious metals, strategic real estate, critical raw materials, these are forms of capital that do not disappear when an algorithm changes direction. But owning assets is not enough. But first, we need to know when and why. Observing geopolitics is not the same as doing politics. It's about understanding where will the pressure come from. And it is precisely in these periods of pressure that opportunities arise. Abrupt reversals, like the one triggered by the spill of 660 tons of silver, are not anomalies. They are moments of transition. The market overreacts, then corrects. Slower-moving players panic. Structured players assess the situation. When prices fall back after a surge triggered by a political shock, it is not necessarily a signal to flee. It is often a window, an area where the fear of some creates room for maneuver for others. Accumulating cheaply does not mean rushing. It means understanding whether the correction is emotional or structural. At this point, one thing becomes clear. Your portfolio is not isolated from the world. It is connected to decisions made in offices you will never enter by players who don't speak to the markets, but who move them. The awakening is brutal, but it is invaluable because it dispels a dangerous illusion that everything will be fine as long as I don't touch anything. From that point on, a responsibility emerges, that of transforming information into strategy, understanding in positioning, fear in lucidity. To fail to act after understanding the rules is to let others decide for you. And in this particular game, those who anticipate the hidden rules aren't trying to beat the market, they're trying not to be crushed by him. This moment is not an end, it's a silent tipping point.